My name is Ernie Humphrey. I'm the Vice President of Educational Programs for Proformative, the online community and resource for corporate finance, accounting, treasury, and related professionals. First, I'd like to welcome everyone to the webinar, Leveraging Cross-Border Payment Efficiency in FX Risk Management. Increasing currency volatility continues as global political and economic conditions continue to remain unstable, with no signs of improvement on the horizon and the very future of the euro coming into question. As currency volatility and uncertainty in global markets increase, effectively understanding and mitigating currency risk exposures becomes ever more important to companies. Effectively managing FX risk is challenging, and getting the blocking and tackling right is critical. And choosing the right providers and executing FX payments and mitigating FX risk can help set a solid foundation for an FX risk management program. Our content today will offer an overview of the current state of the union in global currency markets with a particular focus on the euro, a review of the results of the 2011 Proformative Cross-Border Payment Survey, and a case study illustrating the power of choosing the right FX payments partner. I would like to thank Western Union Business Solutions, whose commitment to thought leadership helps make this event possible and delivered at no cost, like everything on Proformative. A quick note on today's agenda. First, we will hear a presentation from a renowned currency market expert on the current state of global currency markets. Next, I will offer a brief presentation of the results of the aforementioned cross-border payment survey. Our final presentation will offer a case study from a firm that has recognized the value in choosing the right FX service partners and is just beginning to bear the fruit of laying the foundation for an effective FX risk management program. We will then conclude with an interactive Q&A discussion that I will moderate with our session speakers, where we will spend the remainder of our hour. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our best and we'll follow up afterwards on any questions we did not get to. A few more logistical notes. We will post the presentation to the Proformative website where it will be freely available, and we will send you a link to the deck as well. Also, note we are offering CPE credits for the CPAs in today's audience. If you did not click the box on the way in for the registration on the last slide of our presentation today, you will see the email for Tanya Walsh, who administers our CPE credit program. So if you have any issues in getting your CPE credit certificate for today's event, you will email Tanya Walsh. A quick word about Proformative. Proformative is the largest and fastest growing online resource for senior level corporate finance, treasury, and accounting professionals. Proformative offers a uniquely noise-free and valuable online peer network, direct subject matter advice, and features and resources developed in direct collaboration with our constituency. You can see this in the recent features added to our business directory, which now includes videos and features product and service provider reviews written by corporate practitioners for corporate practitioners. Okay, let's get started by introducing the speaker for today's first presentation. Carl Shimada, Senior Market Strategist for Western Union Business Solutions, has designed and implemented risk management and trading strategies for hundreds of companies, ranging from small businesses to large corporations. As a member of the Business Solutions analytical team, Carl also provides market analysis and strategic guidance on a daily basis for thousands of international businesses. Carl is a regular contributor to a number of international treasury and finance magazines, and his market analysis and forecasts have been widely quoted by such publications as the Washington Times and the Wall Street Journal. Carl is a member of the Professional Risk Managers International Association, the Global Association of Risk Professionals, and is the president of the Association for Financial Professionals, Calgary. With that, I'd like to hand it over to Carl Shimada. Carl, take it away.
Thank you very much, Ernie. That was an excellent introduction. It's a huge pleasure to be joining this discussion today, particularly given the fact that the currency markets themselves are providing us with so many interesting things to talk about. We're definitely not living in boring times here. So now, over the next few minutes, I'd like to provide an overview of what we're seeing in the world of foreign exchange and outline some of the risks and opportunities that treasurers and financial professionals might want to be watching out for in the coming year. Now, before we get started, I'd like to actually drill things down to their most basic form. If you look at the structure of the foreign exchange markets and you look at the available money supply in a country and you multiply it by the exchange rate, you get the price tag for that country. So, in other words, you get the value for your country by multiplying that money supply by the exchange rate. And that really makes sense until you consider recent history. At various times over the last few years, we've seen those price tags change far more dramatically than fundamentals would suggest. Entire countries have dropped in value by 10% or more in the space of a few hours. In a sense, human irrationality explains this. Our emotions often guide us more than stone-cold logic does, so mispricing in the markets often occurs. But there's actually another explanation as well, and that is that exchange rates essentially act as a measure for the global flow of capital. So, when capital flows into a country, its exchange rate rises, and when it reverses and flows out, its exchange rate falls. Once upon a time, capital flowed between countries as goods and services were exchanged, and trade essentially drove the rise and fall of currencies. If you were a foreign exchange trader back in the 70s, the trade flow data was an absolutely essential day of the month to be in the market and to be trading. That is no longer the case. Today, as this graphic illustrates, currency market flows now dwarf trade flows. This is drawn to scale. So while we currently trade something close to 28 trillion a year between countries, we're turning over roughly 1 quadrillion a year in the foreign exchange markets. Almost sounds like an imaginary number until you see it drawn to scale there. So if we want to understand what's happening to exchange rates, we really need to understand the flow of capital. And to do that, we need to understand what has been driving that flow over the last few years. So I'll start by rewinding the clock a bit, back to the financial crisis in 2008, which really was a watershed moment for the global economy. It was the first time that global GDP fell in a synchronized manner. A liquidity contraction that began in Western financial markets was transmitted across the entire planet swiftly and dramatically. And as this chart illustrates, during the crisis itself, the US dollar outperformed every other major currency. Why was that happening? As investors were withdrawing money from the international markets and pouring it into things like US Treasury bills, you created positive demand for the US dollar as a currency. And effectively, as everyone ran for the exits, investment and lending activities ground to a halt on a global scale. So trade slowed and the crisis in the real economy began. In response, the Federal Reserve stepped in to kickstart the real economy by pouring liquidity into the system. So Mr. Bernanke and his colleagues printed massive amounts of new money and made it cheaply available by driving interest rates down to historical lows. Now, in theory, this new money should have found its way into the real economy, but instead it had an unintended effect. When with so much cheap money available and relatively unattractive domestic investment prospects available, traders were able to borrow in the United States and Japan and lend into higher yielding currencies like Australia. And that allowed them to capitalize on the interest rate differential and profit substantially in the process. And of course, that's exactly what they did. If you look at this slide, we saw the post-crisis period change the face of the currency markets. The patterns seen during the financial crisis were flipped. The dollar and the yen fell in value because they were the funding currencies, and the Aussie, the Kiwi, and the Loonie, for example, went on a tear. And this continued for almost 2 years. Valuations were very clearly getting stretched and were moving into dangerous territory by early 2011. So, of course, the party had to end sometime. The market really just needed someone to sound last call, as it were. And that happened when the financial system began to realize just how dangerous the Greek debt situation really was and how interconnected the exposures were. Many traders saw echoes of the Lehman debacle and began to get extremely nervous about the global risks that they were facing. So they began to repay their borrowing positions in the United States and sell their assets abroad. As this process unfolded, we saw the post-crisis era come to a messy end. As you can see in this chart, correlations broke down very quickly, and currencies began to head in wildly divergent directions. Many currency traders and hedge funds lost their shirts in this process as long-standing patterns descended into chaos, and really at the same time, treasurers found themselves dealing with an extremely unpredictable environment. And that brings us to today. As we begin 2012, the balance between the major economies is shifting, and capital flows remain vulnerable to very sharp reversals. Volatility is not going away in no shape or form. But interestingly, that volatility is not always what we think it is. And I want to highlight the euro here today because this chart shows the euro's movement against the US dollar since its construction in 1999. As you can see, despite the endlessly negative news flow, the currency has actually risen substantially over time. If you look at the levels that it was holding in the early 90s, or the early 2000s, I should say, the euro is well above those levels. And as a matter of fact, from a fundamental purchasing power parity perspective, the euro actually remains slightly overvalued at the levels that it's trading today. So what's interesting here is that many observers are very baffled by this. How can the apocalyptic headlines possibly match up with this performance? I would suggest that it comes down to a rather basic fundamental. That is that the European crisis is actually a series of growth and liquidity problems rather than a true existential threat to the common currency. So the common currency itself is not going away, and traders know this. I know that sounds rather flippant, but the reality here is that the total outstanding balance of Greek debt, for example, is equivalent to the GDP of Germany's third largest state. So traders know that the core countries retain a vast amount of financial firepower that just simply has not been deployed very effectively. Now, if you look at that from a trader's perspective, that makes the average trader extremely nervous. They're nervous about being on the wrong end of the barrel if policymakers ever do pull the trigger and put that firepower into action. So they've been largely unwilling to build up massive short positions in the currency and have often stepped into long positions in an effort to benefit from positive news flow. This effect is being lost in the general media coverage of what's happening. So these countervailing pressures have effectively kept the currency in balance thus far, but we really do have very large question marks hanging over the year ahead. And really the first is macroeconomic. Last year's repeated panics in the euro area forced financial institutions to hoard cash and drastically curtail their lending activities. Now, in a sense, this was good because it meant that they didn't fail and cause the sort of chaos that followed Lehman Brothers a few years ago. Unfortunately, it also meant that the supply of credit to the real economy dried up. And this is really what foreign exchange traders are watching today. This liquidity contraction, if you will, is very likely to damage the growth outlook for Europe over the coming year. We simply don't know how bad the damage will be. But we do know that this has put a lot of pressure on politicians, particularly those who currently hold power, and particularly those in the core countries that are funding the Euro project. Now, if we take a step back from this, up till now, despite headlines to the contrary, I would suggest that we've seen a pattern. Politicians in the core countries have demonstrated an ongoing commitment to protecting the core interests of the common currency. Now, this does not necessarily mean protecting Greece, given that it's a tiny economy relative to the EU. It has not meant intervening to prevent a short-term surge in Italian bond yields. But time after time, when push has come to shove, leaders have pledged their national balance sheets to stabilize the common currency project and the financial sector itself. Why? I'd argue that it's because their individual careers and legacies depend upon it. No modern European politician wants the blood of the common currency project on their hands. So they're doing what needs to be done at its most basic. But this is changing as conditions in the real economy worsen. In France and Germany, leaders are now fighting Eurosceptic opposition forces that look likely to take power over the next year and a half. Sarkozy in particular looks vulnerable to a fall as the April election approaches, and the opposition has already declared its intention to rip up several of the euro area treaties. At the same time, in the peripheral countries, technocratic governments are living on borrowed time. Both in Greece and Italy and Portugal, you're seeing technocratic leaders who are now under pressure. They're attempting to pass reforms before the people turn against them and elect populist Eurosceptic governments instead. So given this balance of factors, we believe that the ironclad commitment that we're seeing will give way to a rather sober realization, and that is that restructuring is both necessary and inevitable for the common currency area. And to put that in more specific terms, the common currency area will have to change very dramatically in order to address competitive imbalances and also put government finances on a more sustainable path in the longer run. Now, as we move through this process, I would expect that we see several currencies or several countries that see the need to leave the currency union, those that are not achieving a strong economic gain as part and parcel of their membership in the common currency. At the same time, several others may want to pursue deeper fiscal integration. Either way, the euro area is going to change. All of that being said, though, I want to highlight the fact that the currency itself will be subject to some very different forces. And, you know, this really reminds me of the situation that we saw in the United States a few years ago. We could see the euro exhibiting some very counterintuitive trading patterns over the coming year. In the early part of the year, Europe will remain in turmoil. There's really little question of that. And the global environment will remain dangerous as a result of that turmoil. So that should act to keep traders in an uncertain state, to make them nervous about borrowing in the euro area and investing internationally. As a result, I would suggest that the currency will remain surprisingly stable in the coming months. However, that will change as the year progresses. Drag will increase as the year moves forward, as those worries dissipate and as traders become more comfortable with the status quo in the euro area. And I want to emphasize something here. So for traders that are exposed to international markets at this point in time, they have a wonderful thing coming in the euro area. They have the ability to borrow in at negative real yields, and they have a currency that is incredibly weak. Therefore, they are able to borrow and lend internationally. And this is a parallel of what we saw in the United States 3 years ago and in Japan over the last decade. So, in effect, what this means is that the status quo will essentially weaken the currency despite a general improvement in political conditions in the euro area. In short, really good news for Europe may actually be a positive for the currency, and really bad news could also be a positive for the currency. But normal, everyday, average news will lull traders into a comfort zone and put downward pressure on the currency itself. But, you know, it's not all about Europe. So let's flip over to an area of the world that I think is not receiving enough attention from the media and maybe from treasurers in general. Here's a chart showing the trading patterns seen in the Chinese yuan over the last 11 years. As you can see, the yuan has risen against the US dollar at a measured pace over the years. Not as quickly, of course, as external observers would like, but it has been a fairly steady increase. However, this year may be one in which the pace of appreciation actually begins to slow. Why is this? Essentially because China is quickly realizing that its growth model is not sustainable. It has built an incredible amount of economic momentum by continually shifting resources away from households and into state-directed industrial investments. It has done this by printing money, artificially holding interest rates down, and by keeping the exchange rate itself undervalued. Unfortunately, this effort to manage the economy from above is effectively skewing the investment feedback loop, if you will. And it's creating massive resource misallocation problems. Money is flooding into projects that have little productive use in the long run. So things like cities with empty apartments in them, speculation in the financial markets, speculation in the commodity markets, and high-speed rail lines with very few riders on them, very few people who can afford to actually ride on the rail line. Something is clearly wrong in the Chinese economy, and the leadership is well aware of this. So they're attempting to recalibrate things. They're looking to prick asset bubbles before they grow dangerously large, and they're trying to put the economy on a more stable foundation. In specific, we expect to see monetary tightening in some areas, privatization of state companies, elimination of price monopolies across much of the Chinese economy, and a rise in the exchange rate over time. Of course, there are barriers in the way. Primarily, there is a lot of political capital invested in the current model. And this year is a particularly important year in China. Few Chinese politicians will want to rock the boat as the 18th National Congress happens, and that's when the fifth generation of leaders gains power. They're not going to want to make rapid modifications. They're not going to want to uproot or upset the populace while that's happening. So we see this process being quite slow and measured in the months ahead. As a matter of fact, we may see a short-term reversal. As Chinese policymakers seek to insulate the country from problems happening in global export markets, you could see stimulus happening. You could see monetary loosening for a short period of time. Ultimately, however, we are looking at a change in the dragon's appetite, and treasurers should be prepared for that. It won't necessarily look like a slowdown from an outside perspective, but as the economy shifts towards households and away from fixed investment projects, we could see a corresponding moderation in China's demand for raw materials. And I want to emphasize here that that's particularly the type of raw materials that are produced in other parts of the emerging world. So that will add to the stress that's already being felt in countries like Brazil, and leads us to really urge caution when you're taking on emerging market exposures in the near future. To be perfectly blunt, China and the emerging markets in general are no longer the one-way bets that they have been for many years, so you need to be a lot more cautious about what exposures you're taking on. As for the Chinese currency itself, we expect to see the currency continue to appreciate, but more slowly than it has in recent years. At the same time, though, the country is likely, as I mentioned earlier there, to push more money into the system and reverse some of the recent tightening measures. And that echoes what's happening in Europe. And effectively what it does is help to loosen global monetary conditions in the process, which really brings us back to where it all started, where the monetary loosening started. Here's a chart showing the trading history of the US dollar over the last 10 years. And this is calculated on a trade-weighted basis against the major since 1999. As you can see, the dollar has been the biggest loser or the largest loser over the period on an aggregate level. But what's interesting is if you look at the last few years here, we've seen we've entered a pattern, and this is a pattern that traders really would call range trading. In other words, there's been no clear direction to the currency's movement over the last few years. And you know, I guess we need to look at a couple of things here. The first is that when we look at the economy itself, I would suggest that we are seeing a dramatic rebalancing in the United States, almost the mirror image of what is happening in China. We're moving away from a consumption-based model towards an investment-based model, while the Chinese economy is doing the opposite. The entire economy is shifting onto a more sustainable path. Now, of course, at the same time, that's causing substantial collateral damage. As the economy changes, that leaves many people out of work and ill-prepared for the opportunities in the new economy. But ultimately, this is laying the foundation for future growth. You're seeing a shift away from the debt-fueled growth of the last decade, and you're seeing a steady recovery in the type of credit that matters. That is the money that's available to small and mid-sized businesses. For much of the post-crisis period, we saw that money locked up, and as a result, the economy had very difficult headwinds to overcome. Unemployment is high, but the aggregate workforce is posting, and I would say, really astonishing productivity gains. And you know, if we look at the global environment here, half of America's exports do go to Europe, but at the same time, we're seeing lower supply chain costs and also strength in the domestic markets in the United States that are helping to offset that. Now, and if we get further into the domestic environment, into the policy-making environment, we're also seeing a degree of stability. While the political parties are often deadlocked over the details, and you know, certainly this is front-page news at all times, we are actually seeing cross-aisle support for reducing the deficit and for tackling the debt itself. And I would say that that echoes something we saw in the UK 2 years ago. We saw very much that same resolve to address economic problems, and that was supportive for the currency for quite a long time. At the Federal Reserve, we see a commitment to keeping the economy well supplied with capital, but also a recognition that it would be both politically unpopular and economically dangerous to engage in another massive monetary stimulus project. So missteps can still occur, and you know, I would certainly highlight the regulatory arena as a place where that might happen. But overall, this is an environment that is good for business and for domestic investment prospects. Now, and it's interesting, coming from a currency trader, coming from my particular contrarian stance on the markets, I know that this all sounds overly positive, but the reality is that in the foreign exchange markets, everything is relative. Of the major economies, the United States is now the only one that has a reasonable possibility of growing faster in the coming year than it did last year. GDP growth is currently beating the EU, the UK, and Japan. So, you know, I guess I would characterize our economic outlook as cautiously optimistic and certainly vulnerable to changes. But in relative terms, capital flows are likely to be supportive for quite a while yet. For the early part of the year, investors should continue to see the U.S. as a safe haven from global turmoil and will correspondingly value U.S. dollar assets and investments. Money will continue to flow in and support the currency. At the same time, traders who have the choice of borrowing in U.S. dollars or borrowing in euro will likely choose the euro, given that it's had a much weaker performance over the past 6 months. And important to note there, traders' memories are not very long. So money will not tend to flow out of the United States in the large quantities that we saw in the post-crisis period. However, toward the latter part of the year, the chase for yield is once again likely to trump the need for safety. So we do expect to see renewed weakness on a trade-weighted basis, toward the end of the year, really past the election period. So, that picture really brings us to looking at the entire world as a whole. I'd like to finish with a couple of global conclusions here. Firstly, I'd strongly suggest that the emerging markets are decelerating, even if it hasn't become clear yet, while at the same time major parts of the developed world are actually accelerating, even if that hasn't become clear yet. So outcomes across the planet are effectively converging. And I think that what's important here is to note the impact on the flow of capital that might have. As traders and investors become aware of that truth, of the convergence of economic conditions, the one-way flow of capital that you can see in the charts that I started with is very unlikely to be repeated. At some point, the risk-on, risk-off trading phenomenon will disappear, and that means that correlations are unlikely to last for very long. Secondly, the safe havens that we've seen performing so strongly over the last few years are looking very overvalued on a number of fundamental levels. Essentially, too much capital has flowed into markets that are ultimately too small to handle it. And that makes them vulnerable to shifts in sentiment. This is what a currency trader would call a crowded trade. So I would suggest that treasurers look farther afield when they're looking for safety. Look for low correlations, look for relative undervaluation, as opposed to basing your decisions on the fiscal position or the high commodity exports of a particular country. Those are things that are vulnerable to change, which naturally brings me to asset prices and to commodity prices in particular. In recent years, prices have been driven ever upward by the availability of cheap money and by the emerging market story. That story of increasing demand has been a huge propellant for prices. Now, these narratives cannot be sustained forever, so it's a good idea to begin thinking about what will replace them, whether it's the focus on tensions in the Middle East, for example, or a recognition that that a slowing global economy will hurt the demand side of the equation, or both at different times. So, it's very, very important to look at things in a more nuanced way than we have in recent times. And lastly, if there's one risk factor I'd really be watching out for in the year ahead, it is in the political arena, and it is bimodal. At no time in recent memory have as many policymakers had the mandate, the capability, and the motivation to intervene in the global economy. And if politics is anything, it's unpredictable. The media rarely gets it right, so risk managers need to continually price in a full range of possibilities, both on the positive side and the negative side. There are significant downside risks facing us in the event that policymakers get it wrong, but there are also substantial upside risks in the event that they restore confidence in our institutions and our markets. Either way, policymakers are going to change the rules this year. So, saying all of that, one rule won't change, and that is that the only certainty in this environment is volatility. We simply don't know where currencies will go and when. But if you think of this in another way, or you think of it from a currency trader's perspective, volatility really equals risk and opportunity. If you manage to balance this effectively, you can build a more competitive position for your company and a much more sustainable position in the world of international trade. Fortune really favors the prepared. So, and really that is what our session here today is about. So to talk about how successful businesses are doing this, how they're balancing risk and opportunity in the currency markets, I'll now turn you over to Ernie and Hillary here. Thank you.
Thanks, Carl. That was great content, great insights. At this point, what we're going to do is we're going to launch our first polling question. We would very much appreciate your participation in the poll. Please note that for those of you in the audience who are after CPE credit today, that we will need you to answer both of the polling questions that we pose during the webinar today. Just a little recap as we move forward in the presentation. Carl has offered us great insights into global currency markets and certainly has gotten our attention as to the importance of effectively monitoring and managing FX risk exposures. In particular, I found his view on the future of the euro in itself as a currency very compelling. I'm sure we'll have some interesting back and forth in the Q&A session, and also his great insights into the other currencies that we need to watch. As he mentioned, all of the press is really around the euro, but there are some other currencies that we need to keep our eyes on, especially we need to watch things in China as well. As I previously mentioned, having an effective FX risk management program, that starts with a solid foundation. And an integral part of this is having FX service providers to assist in the execution and strategy behind your FX payments. So prior to the current euro crisis taking hold, we noted several conversations among the Proformative community members sharing their struggles around cross-border payments and FX risk management. In response, Proformative developed a survey to offer insights into the challenges in making cross-border payments and engaging the right service providers in this endeavor. Before we dive into the survey results, I'd like to offer just a little background around the survey, including the demographics of our survey respondents. Now, if you take a look at the survey respondents in terms of currency exposures, looking up in the upper left-hand corner of our screen, we see that over 50% of the respondents face exposures to the euro, Canadian dollar, and the South African rand, with the euro leading the way with over 25%. A few notes of interest here. We found the fact that the number of firms exposed to the South African rand interesting. And the other thing that we noted is a fact that I feel that is often lost when companies and the news report on currency markets, in that Canada is our largest trading partner, and that the volatility of the Canadian dollar is very important to U.S. firms, and that doesn't seem to get the attention that it needs at times. If you look at the company industries by the respondents, up in the upper right-hand corner, our second graph there, you will see that these industries cover a pretty wide spectrum, with manufacturing, financial services, and computer software leading the way. I think we may have some interesting questions for Carl in the Q&A sessions regarding the exposures that are faced by firms in these specific industries. In terms of annual revenue, if we look at the bottom left-hand corner, a vast majority of companies represented fall into the small and medium business space, what we affectionately call the SMB space, and this makes sense given that this was the primary focus of our survey outreach. As we all know, the complexity of FX risk management often does not correlate with company size, but size often affects the amount of resources available to manage the risk, and that is why the selection of the right FX service providers is even more critical for firms that fall into this space. If we look at seniority of the respondents, 71% of those hold the title of director above. If our demographics had shown us that the respondents were all from Fortune 500 companies, we may have actually had a bit of concern in that these people may be somewhat removed from FX risk management. However, given the demographics of our respondents being in the SMB space, in general, we believe that this degree of separation, if it exists at all, is very minimal. Just a few more interesting points as far as the survey demographics. The majority of respondents report that their average size of payments in terms of U.S. dollars are less than $50,000. We find this interesting and compelling in that, in general, the smaller the payment, the wider the spread you'll receive on FX payments if you are receiving multiple quotes on these smaller payments. That means having the right provider to get you the best rate is critical for these firms. And I can speak to this directly from my experience as a corporate practitioner in managing FX payments for 5 years. Large spreads on small payments, they add up very quickly, and they can offer some low-hanging fruit as far as the benefits to taking more and better control of your FX currency payments. And Hillary will attest to this fact as well later in her presentation. finally, a couple more notes on the demographics before we get into the results. The majority of companies are using bank-provided FX payment platforms to make payments, and I found it interesting to note that despite advances in technology, that 18% of the firms we surveyed are still, in fact, phoning in their FX trades. Now, if we get to some of our key results, when respondents were asked to identify the biggest challenge they faced in making cross-border payments, maybe not surprisingly, high fees and additional hidden transaction costs were the top response. But we found that the fact that 28% report currency volatility and payment timing is noteworthy due to the fact that not understanding volatility and how to direct your providers to make the payment at the right time in and of themselves inhibit effective FX risk management. This result is interesting when you look at the response given to our next question as to the main reason that current FX service providers were chosen. In that question, only 11% identified the level of expertise, which there seems to be a disconnect there. Given that this is their largest issue, it seems like there would be more of a correlation between their biggest challenge and their choice in that sense. Now, of course, the next thing is, the next comment is going to be, well, the banks in their bank group offer that level of expertise, but I would argue, you know, even if we believe that these banks offer a great level of expertise, which they almost certainly do, this results that companies are not being exposed to that expertise and being allowed to leverage it for their companies. If they were, we might have expected that 28% in our first question to be much lower. And just, you know, another point back on that question as far as the primary reason for choosing your firm, you'll see that leading the way is that the firm is already in the bank group. And I know as Treasury professionals, sometimes we feel constrained, and sometimes those banks do offer the best service level and the best rates, but it comes down to that cost-benefit analysis when you're assessing the value that truly that best partner can bring, and that may or may not be within your bank group. Another interesting result to point out is that I kind of came up with this question. Whether or not it's clever is up to the audience to decide. We framed the question around if there's one thing that you could change about your current FX provider aside from lowering the fees, what would that be? When asked what they could, 47% conveyed a wish around improving payment execution, and those included making the payment execution less complex and increasing payment reliability. A few other notable results that we have on our slide here is that given the importance of effective FX risk management, we see that only 50% of the respondents actively monitor and manage their currency exposures, and 40% reported that their companies have a formal FX risk management policy. And this kind of gets back to the fact that an effective FX risk management program starts with a solid foundation, and part of that foundation is actively monitoring and managing currency exposures and having that formal FX policy, and in addition to obviously selecting the right provider, which can be a key resource in offering you those resources to get that effective program put into place. I want to summarize with some survey conclusions. The full survey results are available on Proformative.com. I want to make sure that I leave Hillary some time to get to the case study from her company, and also leave us adequate time for the Q&A. Again, the major survey conclusions are the major pain points faced by companies are the hidden transaction costs, and what we noted really compelling was understanding the currency volatility the companies face in order to mitigate risk by optimizing the structure and timing of payments. And another interesting conclusion we have drawn is the majority of companies are not selecting service providers based on the criteria that allow them to most effectively manage cross-border payments and currency risk. In fact, only 20% of the survey respondents identified customer service at the level of expertise as the main reason for choosing a partner in managing FX payments. And this, in some sense, flies in the face of the best way to effectively manage your FX currency process. And at the end of the day, companies want more efficient and transparent process in executing cross-border payments, and their ideal partners would help educate them in understanding and more effectively mitigating the currency risk that their companies face. An overarching conclusion when looking at the survey results is that in some sense, companies cause their own FX payment headaches in not aligning their company's risk management needs with their choice or choices of FX service providers. Building a relationship with the right partners can eliminate top challenges, grant wishes to improve service, and also lay the foundation for an effective FX risk management program. I would now like to introduce our final speaker of the day and one of our survey respondents who will share how her company has recognized the value in choosing the right FX service partners and is just beginning to bear the fruit of laying the foundation for an effective FX risk management program. Hillary Ferrone is the Assistant Treasurer at Houghton International. She's worked at Houghton International over the past 6 years in roles of increasing responsibility, including accounting manager, and has served in her role as current Assistant Treasurer for the past 3 years. She has earned her undergraduate degree from Emory University, her MBA from the University of Oregon, and is a certified Treasury professional. I will now hand the floor over to Hillary. Hillary?
Hi, thank you, Ernie. Just wanted to start by saying that I'm very happy to be able to participate in today's event. And as Ernie said, my name is Hillary. Let me give you a little bit of background about Houghton. It's been around for 147 years and is a specialty chemical manufacturer primarily serving metalworking industries. Our annual sales for 2011 were approximately $900 million. So we're a little on the larger side than most of the survey respondents. We have operations throughout North America, South America, Europe, South Africa, and Asia Pacific. In 2011, approximately 65% of our annual sales were denominated in foreign currency. And that was actually a big change for us. Prior to 2011, the majority of our sales were generated in the United States. So this really, in the last year, has become an important factor for us and why we started looking at a service provider who could help us in many different ways. Our main currency exposures are the euro, Canadian dollar, the Chinese renminbi, and the Australian dollar, but we also have exposure in Mexican peso, Brazilian real, Taiwanese dollar, and the baht. Historically, we did not have a formal program, and we were very decentralized in repatriating funds and making cross-border payments. We had each of our entities conducting their own spot trades with very little oversight. So, we have just started our formal FX risk management process, and one of the things we're doing is trying to centralize all of our cross-border payments. Kind of in a two-prong approach, both doing them through our corporate offices here in the U.S. and also using our service provider's website as it's available internationally. So we're working kind of in both areas in that respect. We've also been working closely with our service provider to identify and understand our FX exposures, to determine if we need hedges or where our natural hedges occur. And then we've obviously created a formal hedging policy and are putting that in place ongoing at this time. Before we started our project, we really allowed anyone who needed to do an FX transaction to do it locally. So they were using their local banks. Whoever was available, wherever we had accounts, we fell into that trap of, doing what was easy. So we had at least 10 banks, processing foreign trade transactions for us. So we're still consolidating, but we've already eliminated one in the U.S. and one in Canada, and now we're working globally again to use our current FX service provider. Our main criteria was really someone who could be a strategic partner for us. We recently refinanced at the beginning of last year, and the service provider we're using was part of our refinancing. And we've worked closely with them, and they've really been beneficial in looking at our situation and helping us determine what we need to do. So we've been building a nice level of trust with them over the last year. They have very good expertise and have been very helpful and accessible to us in helping us understand our FX risk. And then obviously, we've also gotten cost savings, always important. So on a strategic level, obviously, they've looked at our transactions and our exposures and have helped us determine whether we need formal hedging products and how our natural hedges can kind of be best used and best help us. We've also gone to them with the current Euro crisis and asked their advice. We asked them if they were doing anything in particular to be prepared for this, and asked how we could be best prepared. So they've actually given us some good advice on what we should and shouldn't be doing in that regard. And it's a level of comfort having that person to be able to go and talk to. And then in regard to our cost savings, just since April of last year, we've saved right around $60,000 on our spot trades. So that was a nice, calculable savings that we had. We were very similar to the respondents in the survey. We really fell right in line with the same issues everyone else was having. Our biggest challenge is the currency volatility. That's something we still need to work on. As I said earlier, our primary reason for choosing a firm was who was already in our company's bank group. Where was it easiest to make the transaction from? We probably never even previously asked for expertise in regarding the risk management, in part because we were doing it so decentralized. So that really is a big change for us, and having that expertise is very helpful. Right now, my main wish for an FX service provider is understanding different requirements in different countries, specifically China. I'd like to just have someone who could actually do an FX transaction in China with the Chinese renminbi. It tends to be a little difficult for most providers. Thank you all very much, and I hope this was informative.
Oh, thank you much. Thank you very much, Hillary. It's very insightful to have the practitioner's perspective, and just to see, how this process can work for some of you out there who are facing some of these similar headaches, and kind of taking control and kind of administering your own aspirin, so to speak. And as Hillary mentioned, she's probably on the cusp of the benefits that she is going to realize in terms of the low-hanging fruit. We would see that in terms of those savings as far as the spot trades and the rates, and I think it'll only get better from there. So before we transition to the Q&A portion on the webinar, we're going to launch our second polling question. As a reminder, if you have a question you would like to have answered by the panel, please ask it via the questions area in your GoToWebinar panel. Again, we like to make this as interactive as possible. So if you have a question that you'd like to have answered by the panel, please ask it via the questions area in your GoToWebinar question area. As I mentioned before, if we're not able to get to all the questions during the Q&A session, we will post the questions and the answers, so to speak, out on the Proformative website. as we're finishing up the survey. We'll have that up in just a few more seconds. I think I'll go ahead and tee up the Q&A session with a question for Carl. I've got a question for someone as far as if you're seeing any trends as to how companies are beginning to prepare for the euro crisis, what they're doing in terms of their policies, procedures, and maybe their hedging strategies. Carl?
Sure. Definitely something that's become increasingly important in just about every boardroom in North America. I guess the key thing to think about here is that the euro crisis from here is a deeply, deeply unpredictable thing. So you could be looking at a risk to the upside in the sense that Spain, for example, could suddenly announce that it's going to leave the a risk to the downside. Spain could suddenly announce that it's going to leave the common currency, or you could see something on the other side, like the European Central Bank announcing that it will purchase unlimited amounts of sovereign debt and therefore stabilize the entire area. So what we're really seeing is we're seeing an increased focus on hedging strategies, both financial and natural, more usage of things like currency options and just simply, ratcheting up the hedge ratio for many companies. You're seeing a focus on pricing flexibility as well. Companies that are shortening payment terms or inserting clauses that allow them to reprice in a different currency or to reflect change in currency values. You're also seeing diversification. You're seeing companies that were very, very reliant on exports to Europe that are now making the effort to sell outside of Europe. And at the same time, I'd say that at a strategic level, at a corporate level, we're seeing companies firstly shifting away from this focus on payments, on the idea that each payment is an individual entity. And not seeing the bigger picture. You're seeing companies actually trying to define what the big picture is, what the flows look like over a year. Very much as Hillary mentioned there, trying to identify those natural offsets. And you're also seeing a focus on communication, because the reality is if we do have that unpredictable event that's either to the downside or to the upside, it's very unlikely that we're going to know how that'll transpire in advance. Therefore, you're seeing the C-suite level executives arranging plans so that they're able to communicate with each other in the event of a crisis. In the event that things really do go sideways, that they're able to actually make decisions and react to changes in the environment versus trying to identify what those changes will be in advance.
Okay, great. I have maybe it's kind of an ancillary question for Carl. Someone's asking if you could give me, 3 key takeaways from this webinar as far as how to prepare my company for the impending volatility. They have exposures to the euro and also exposures in China. What would your advice be to them to react, but also how to ensure that they don't overreact?
Sure. I guess the primary takeaway that I would suggest is to focus on process versus on the specific risks that you've identified. Put in that 4-step process where you're understanding the exposures that you have, where you're strategizing, picking the tools in advance of a market situation, where you're then executing on that strategy on an ongoing basis, and then where you're documenting that. That process focus is absolutely critical to remaining sustainable in this kind of an environment. The second thing that I would strongly suggest, and I think I definitely hammered it home earlier, is do take your focus off Europe in particular. Firstly, Europe is impacting the rest of the world in a lot of ways. And secondly, the amount of noise coming out of Europe is distracting a lot of executives from looking at the situation elsewhere, and in particular in China. And I guess that's the one thing where, I was just talking to a reporter last week about this, where, everyone he's talking to is saying the same thing, that the music's playing, we all have to get up and dance, we all have to engage with China and do a lot of business with China, but at the same time, we need to start, making sure that we're robust and we're safe in the event that things do change within the Chinese economy itself. And thirdly, and I think you actually really highlighted it as well there, the fact that exposures to other currencies are actually more significant in most cases. You're certainly seeing the euro at the top of the list right now, But the U.S. CAD pair, for example, U.S. Canadian dollar pair, that's an extremely volatile pair, and it has been something that we've been able to take our eyes off for about 2 years here. We've seen relatively low volatility, a very tight trading range. I would suggest that that will change within the next year to 2 years, and if it does, that will have a material impact. So again, focus on process.
Okay, great. Just kind of follow that question up and throw that to Hillary. Are there any specific actions that your partners are asking you to take, or is it just a matter at this point of getting a better understanding of what your exposures might be at this point?
Really right now it's getting a better understanding, and we are kind of looking at what we can do should something happen in Europe, but no specific actions at this point.
Okay, I just have another question for Hillary here. As far as going through the process of centralizing your FX risk management is concerned, can you just speak a little bit to some of the challenges that you face internally, politically, and if you have any tips for how to make the process less painful, or is that something that people readily accepted?
We're still in the process, and we did a fairly informal process, and with the actual centralizing trades, it was, it's been very casual, and it's, we tried to do it. China's actually been asking us to do trades, and we can't. So some people are glad to have it off their shoulders, and others are just like, yeah, sure, okay, whatever. The trade part hasn't been an issue. We've been centralizing a lot of processes over the last 3 or 4 years, so that's helped somewhat, but we do have a kind of constant struggle of stop taking power away from me. So trying to get buy-in is always good, but it is a tough situation.
Great. Thank you very much, Hillary. With that, we're going to go ahead and close the Q&A session portion of our webinar. To be mindful of your time this morning, we'd like to give our special thanks to Carl Shimada and Hillary Ferrone for their time and insight. If you would like us to connect you with either of them, please indicate that on the survey that we will invite you to take. These people are leaders in their field and are an excellent source of information on today's topics. We have to once again thank today's sponsor, Western Union Business Solution, a valued Proformative partner. As a reminder, for CPE credit, if you did not check the box to receive CPE credit when you registered for the webinar today, please send an email, as you see on your screen, to twalsh@proformative.com in order to receive your CPE certificate. Again, please note that we will be sending out a survey and would appreciate your feedback regarding our event today. Finally, I would like to conclude our webinar by thanking you, the audience, for your valuable time, and we hope to see you on proformative.com and future events. Thank you very much, everyone. Have a great rest of your day.